so in which you have to calculate the ROI. So the ROI, you have given the data. So the Regal company reports the following: net operating income is 30,000, average operating assets 200,000, sales 500,000, or operating expenses 470,000. So what is ROI? You can find out ROI through DuPont formula as well. So what is that? Just calculate it. Here it is. If your answer is 15%, then it means you really understand the concept. So let me explain here. Sorry. Here. That this manager, the company utilizes 500,000 sales to generate 6% profit, and company utilizing 200,000 assets to generate 500,000 of sales. Which means, what does this 2.5 shows? This 2.5 shows that company is utilizing or using assets and to generate 2.5 times sales. Right? What does it mean? It means if I have assets of 1,000, it means I will use this asset to generate 2,500 amount of sales dollars, right? And what does this net operating income divided by sales? It means among this 500,000, 30,000 is the profit, which means 6% belongs to my profit. And when we multiply this, it means that the manager or this department or investment center is generating assets to generate utilizing assets to generate net operating income. How much? 15%. So the fourth way to increase ROI is to invest in operating assets to increase the sales. So we're going to have a new example here. That is, assume that Regal manager invests 30,000 pieces of equipment that increase sales by 35,000. So while increasing operating expenses as well by 15,000. So let's calculate our ROI. So our net operating income is now 50,000. Operating assets increase by 30,000, and sales now have increased from 500,000 to 535,000, and operating expenses now have increased as 50,000 as well. So total operating expenses are 485,000. So let's calculate the ROI. So just multiply margin with the turnover. Answer is now 21.8%. Now what happened here? Did you see some kind of interesting event? That margin increased from 6% to 9.35%, and our asset turnover ratio, or this turnover, has decreased from 2.5 to 2.33. But overall ROI has increased 21.8%, right? So what if the manager is evaluated on the basis of turnover? Then we can say that this investment in new operating assets should not be done, as it decreases the asset efficiency. But if the ROI, if you base your decision on ROI, then you can say that the sales, generating sales, extra sales of 35,000, the profit margin increased from 6 to 9.35%. And to generate this 535,000 sales, we are using our assets, which is now decreased to 2.33 from 2.5. Overall ROI has increased. So from our previous example, you have just learned that there are some kind of like like some kind of drawbacks or the benefits of using ROI. So the major criticism on ROI is that managers may not know how to increase ROI in a manner that is consistent with the company's strategy. So in the absence of balanced scorecard, we will just see at the end of the slide that management may not know how to increase the ROI, which correlates to the company's strategies. So if company want to increase its businesses, it means they have to put more money or more amount in operating assets. It means ROI gonna decrease. So then management, they don't believe that if we're gonna invest in our invest in our operating assets, the ROI gonna be decreased. And since then, how we gonna be like evaluated our performance on the basis of what? If ROI, then we are not going into this expansion of the business, right? So it means by using ROI, the company's managers focus will be narrowed. So the second one is that managers often inherit many committed costs over which they have no control. Like I told you, if you are committed to business expansion, then you have to buy land, you have to buy equipment, right? And in that case, managers have no control over the increase or decrease on the ROI. So this may take difficult to assess the managers relative to the other manager. The manager of one department will say that, look, I'm not given bonus just because of I have committed cost, which is the business expansion cost, like legal cost you are paying, or the acquiring of the land, and due to that one my ROI is decreased, but I am doing great work, and the other managers he is not doing the expansion work and his ROI has increased, so you are giving bonus to him, not me. So this is the second biggest criticism. And the managers evaluated on ROI may reject profitable investment opportunities as well. So like I just mentioned, the manager who is evaluated on the basis of ROI, and he will not go into the expansion project, which is actually good for the business for the coming days.